There are some things I'll take a chance on, but life is already enough of a gamble for me to put my whole nest egg in the share market. So I take a calmer path. By investing in private credit, I know my money could be growing, not yo-yoing.
From Barangaroo Studios, the AusBiz COB is the key stuff you need to know about the day in business and finance.
Hello, welcome to the COB Tumble Tuesday. I'm Juliette Sarli, and we are seeing quite a big sell-off coming through in the market today. It can be mainly dragged down to one stock. Let's have a look at where we are seeing the market at the close, down 0.7% there on the CBO 200, the ASX 200, which yesterday looked like it was pushing towards 8,900 points, has lost more than 60 points in today's session, 8,897. And it really is a big drop coming through in the healthcare sector, which is down by some 9%. So let's get to why amidst this Tuesday tumble. Well, it's all to do with CSL, one of the biggest stocks on the market, wiping about 53 points off the overall index. It's flagged 15% job cuts. It's posted its biggest drop on record, down some 17% as we head into the close, cutting around 3,000 staff, as I mentioned, about 15% of its workforce, and revenue also missed expectations. But elsewhere, we had consumer confidence, so the future a little bit brighter. It's at a 3.5-year high after rate cuts, and the sentiment index jumped by 5.7% in August to 98.5. That's the highest level since February 2022, according to the Westpac Melbourne Institute survey. And UBS saying that it was really fueled by that rate cut we saw this month, and they're also seeing a recovery in real consumption of more than 2% year on year. So let's see where we were spending our money. Certainly not on the healthcare sector today. As I mentioned, CSL dragging down that sector. Look, it's closing down by 16%. I think its biggest drop, intraday drop on record. Cochlear down by 0.2%. Ramsay Health, Ansell and Sonic. Well, Sonic is actually going the other way. The miners, we had BHP coming through with its earnings. Look, 26% drop due to China slowing demand, iron ore prices as well. I spoke to the CFO, Vandita Pant, a little while ago, though. She is upbeat. They're still continuing to invest their capex for the next couple of years, around 11 billion US dollars, before slowing to about 10 billion in 2028 to 2030, and shares up because the dividend looked like it was at a bit of a higher end of the payout than what the market was expecting. And looking at tech stocks, which did pretty well today, we've got a lot of earnings in focus, including the big one, Nvidia, next week, but Xero up 2.3%, Zip up by just slightly 0.1%. So as we mentioned, CSL having its biggest drop on record. We'll get a little bit more into that shortly with our COB guest. BHP, though, heading the right way. Woodside, it was also out. Such a busy earnings day, you sort of forget about some of them, but it did rule out making a rival bid for Santos. Shares down by about 3% after posting a 24% drop in first half core profit. We'll be speaking to Meg O'Neill tomorrow. ARB reported sales revenue of just under $730 million. That was up more than 5% on the prior year. And Reliant shares down 7%. It did post a pretty strong rise, though, in full year net profit. And that was supported by the first full year contribution from Holman Industries and ongoing cost savings. All right, let's welcome to the COB Martin Crabb from Shaw and Partners. Good to see you amidst a busy day.
Yes.
So this bloodbath with CSL, what's happening?
Yeah, pardon the pun. So terrible response by the market to a result that prima facie looked like they'd beaten the estimate for this year's numbers, but it was all about the messaging of the company saying that it had probably got a little bit fat and bloated. They were going to rationalise their R&D division, which is where all the drugs of the future are coming from, cutting $1.5 billion out of that, but also guiding operational expenditure higher. So less investment, more on spending. And as you said, 3,000 people at CSL. so if you're a worker at CSL today, you're getting very nervous. Are you one of the 3,000 or not? So that's a big cut. But also planning to spin off Seqirus, which is their vaccination business, into a separate listing and doing a buyback. And all these things are the hallmarks of a company that's basically gone ex-growth. You know, we've got too big, we're a bit bloated, we need to cut costs, we need to rationalise, we need to buy back stock, we need to boost the dividend. These people don't own CSL as a utility play. They own it for the growth and the drug development and you know, the global plasma business, which has been fantastic. These guys were earning 50 cents a share 20 years ago. They're now earning $11, $12 a share. So it has been a fantastic growth stock, 15% compound growth for 20 years. It's an amazing story, but it's been massively derated. Based on today's share price, assuming there's not a lot of change to earnings estimates, and there will be a little bit, it's on a market PE. And you can see the only time this happened was coming out of the GFC, you know, when the market recovered quite strongly and defensive stocks like CSL were left behind. So it really is a massive derating. It's gone from over 45 times to less than 20. So if you're a believer in the long-term business of plasma collection and drug development and that sort of stuff, then you probably have a look at the stock at the moment. But it has disappointed a lot of investors that hold it as a growth stock.
Well, that's what I was going to say. Would you look at that, a 17% drop, biggest on record, and start giving a few people a call and say, look, maybe it's time to buy?
It feels like an overreaction. But just the price behaviour today, Juliette, normally you get, like it gets sold off dramatically, then a bit of buying comes in and then it bounces around. Today it was just down, down, down. It tried to hold levels a couple of times. I just had the intraday tick chart up on my screen and I was just watching it and it was just going down and down. What did it end up? I think it closed on its lows, right? So ended up down 16 or 17%. So that's not signs of people stepping in to buy it. Obviously, it's 5% of the market. It's very well held by the institutions. No one seemed to want to step in and buy it today.
$227.41, so down almost $44 in a day.
It's crazy, right?
What did you think about BHP?
Yeah, I mean, mining results are always a bit of a yawn because they come out with their production numbers beforehand and everyone knows what commodity prices they are earning. So you take the production numbers that were released in their quarterly, you multiply it by what the average iron ore price was and you've got a pretty good read on the numbers. It's more about what they say about the outlook and the iron ore miners are all pretty confident we're going to hold $100 a tonne. They think the cost curve's in the right place and you look at it and say, well, okay, what are they going to do with the cash? A lot of them are paying out higher dividends. A lot of them are doing debt reductions. Everyone's pretty conservative. So these stocks, again, they're probably turning a little bit less, more into utilities. As long as the iron ore price holds up for BHP, they'll have plenty of cash to invest in other things like potash and so forth. But there's a little bit of a yawn today with BHP and I'd probably Woodside as well. Woodside was a little bit weaker, but again, we can track the ore price, we can track their production. We've got a pretty good idea what money they're going to make. It's very rare that a company that size comes out with much of a surprise in the mining space.
One stock that did really well though was Seek, this increase in revenue even though there's been fewer job ads.
Yeah, it's interesting that I think companies like REA, Car Sales and Seek are just showing their pricing power, right? So neither of them have really had any macro tailwinds. In fact, if anything, the employment market's been slowing. Like if we look at job ads, whether it's the ANZ Indeed or the Seek job index, there's less jobs around, so you think volume's falling, revenue's going to fall, but they put their prices up again. Now I've heard anecdotally that a lot of advertisers are choosing not to use Seek because it's too expensive, but in order to get the reach that Seek gives you, you've got to pay for it. So these companies are very, very clever at flexing their muscle and using their pricing power in a way that maintains their revenue and their margins even when volumes are slowing, and that's a sign of a fantastic business with a really strong moat around it. Now obviously Seek's getting competition from other players that are entering the market, but I think today's result just shows what a quality franchise it has and the capacity to maintain their margins when revenues are falling away.
And of course, it really bodes to the overall sentiment of the economy. We've got to pick up in that, or read, I should say, in consumer sentiment as well. You say not enough to really sway the RBA. Yeah,
I mean, I watched the interest rate futures, Juliette, just to see how the market's shifting, and really a little bit higher. So the red line there, which is the market today, versus the black line a month ago, a little bit higher, outlook for interest rates, but they're still coming down to 3. The question is how fast. So as we get data that shows the economy is more robust, and you quoted George Tharanu from UBS, who's a good friend of ours at Shaw's, saying that, consumption's strong, the housing market's picking up, maybe the RBA doesn't need to cut as aggressively. He's only saying one more cut in November, and then he's saying there might be another one in February, but you can see from that the market's pricing in more. So as data comes through that's stronger than market expectations, people might start backing off that second rate cut. We're already at 3.6, maybe we go to 3.35, but maybe we don't go to 3.1, or if we do go to 3.1, it's probably later next year rather than early next year.
All right, getting back to the market, you've started to look at some of their hold, buy, sells. What are they showing you in terms of how things have changed?
Yeah, really interesting barbell. So out of the 100 stocks in the ASX 100, there's only one sell recommendation. So that's where all of the analysts are saying sell pretty much, and that's CBA.
Okay, what a shock.
Yeah, there's 7 buy stocks where that, all of the analysts on average have got a buy on it, and then everything else is an overweight, a hold, or an underweight. If I look at the price performance of the sell, well, CBA's down about 3.5–4% today. If I add up all the 7 buys, they're also down 3.5%. So you avoid stocks where everyone's bullish, and you avoid stocks where everyone's bearish, but ones in the middle, you stay long. So if you look at the market, the holds, the underweights and the overweights, so that's where there's a little bit of crowding around a hold, they've all done up 4 to 5%, so that's been pretty good. So it's just a standout, and I imagine that a lot of that buy would be CSL. Almost every analyst has a plus $300 price target. The stock's $225 today, so there was a lot of buys on that stock, and and that's down very heavily this month. So I think a lot of it's to do with that, but it's more about saying, just be careful when everyone's bullish on a stock. That's where you get the surprises, because if it comes out with a result that no one was expecting, then everyone becomes a seller. There's no additional buyers coming in. So I think that's a bit of I suppose, a warning sign going to reporting season. They call crowded longs. It's where everyone's really bullish on a stock going into reporting season. That's high risk, because if it comes in with a good number, well, everyone thought it was going to be good anyway. If it comes in with a bad number or a bad outlook like CSL, everyone rushes for the exit. So just be careful with those.
All right, and one more week and a bit of reporting season. Is this when we get all the skeletons coming
out?
Yeah.
There's this old anecdote that, you get the cockroaches in the last day of reporting season. In fact, I'm old enough to remember, Juliet, when we had a Perth Stock Exchange, and that was obviously open till 5 o'clock Perth time, or 4 o'clock Perth time, so it was like 7 p.m. Sydney time. So at 7 p.m. the last day of reporting season, they'd all lodge in WA, and that's what used to happen back in the day. There is a tendency for good news to come out early and bad news to come out later. That's not always the case, but you kind of get a feeling that that's probably going to happen this year. As CSL showed, and Amcor and some other stocks, it's pretty tough out there for some businesses, and expectations are quite high going to reporting season. So we might see a few more landmines before the month is out.
All right, Martin, thank you as always. Martin Crabb
always a
from
pleasure.
Shaw and Partners. Will watch out for those landmines. All right, let's get into the stock of the day. And of course, as we touched on, SEEK was a major player today. Jonathan Takadina from MPC Markets, Michael Wayne from Medallion Financial weighed in on their thoughts on the stock.
Technically, if you just zoom out on SEEK, 27 is a big number. It hit that back in 22, and it hasn't been this high since I think it's 21 or early 20s. So here we go. So here you go. That's the chart there. So if it can build momentum here, and it has done this in the past, it actually puts on continuing momentum. Last time it did this, it got up to $36. So I'm actually calling this a buy.
The company had a pretty decent update in May, took a leg up then, and really that momentum has continued into this report, where they were able to provide fairly solid guidance for the year ahead. And the market at the moment, I think, is very focused on companies and their ability to provide guidance. So it does appear that after a decent period of consolidation, that momentum for the SEEK business looks to be improving. Just broadly speaking, looking at the broader economy, there has been a slowing in the decline of job ads, which is obviously a positive for their ANZ business.
All right, let's have a look at the market leaders on a down day. Seek is there, of course, up 8.5%. And a number of other companies that have come out with earnings either today or recently, including ARB reporting sales revenue up 5.3% on the year. Monadelphous also having a solid session, up by 4%. To the downside, of course, CSL there, its biggest one-day drop on record. HMC Capital also coming under pressure. It told investors to expect weaker growth in the coming year. And Reliance Worldwide posted a 13.5% rise in full-year net profit, but it was sold off today, down 7% to $4.29. In the small end of town, Hancock and Gore had a good session. It does look like a lot of these prospectors were there in the small end of town having gains, and Better Entertainment as well, up by about 9%. Brockman Mining did not have a good session. It was down almost 14%, and a number of other energy and material players as well. Tonight, US housing starts coming through for July, along with building permits, and we get a few earnings as well, including the Home Depot, Toll Brothers, Medtronic, and I should point out that building permits show that permits could be down by about 0.2%. Tomorrow, we get the RBA Assistant Governors McPhee and Jones speaking at the Future of Money at the Economic Society of Australia, a webinar. Also, monthly employee earnings indicator for June, so that's total wages and salaries paid by employees. And earnings include Stockland, Santos, Iluka, Breville Group, Superloop, and we are going to have a number of those executives on air. We'll also speak to Meg O'Neill from Woodside and bring that to you in the 10-hour show. We are closing down by 0.7% there on the CBO 200, the ASX 200 retreating from records, really, as Martin was talking about, dragged down by CSL, which has taken about 53 points, I think, or something off the index. So falling below 8,900 points. Gosh, my brain is starting to hurt. So 8,896 is where we are finishing, down 63 points. And yeah, if you have a look at the sectors, really tells a story. Healthcare down 8.5%, dragged down by that CSL result. All right, on that note, we'll leave it there. We'll be back from 9:45 a.m. Eastern. Enjoy your evening.
The COB is brought to you by Montgomery Investment Management. The world is volatile. Your financial future doesn't have to be. Find out more at montinvest.com.